Hi, welcome to SuperMacro's new podcast. My name is Elvis. I'm joined by Jonny Matthews, the heart and soul of SuperMacro. Hi, Jonny.
Hi, Elvis. Hi.
Jonny, tell us what you want to talk about.
Right, well, we've got a special guest coming on the show later, Andy Constan. Before he arrives, I'd like to discuss the economy, today's CPI print, which was incredibly weak, and I'm going to cram it all into just 5 minutes because we really want to get Andy on the show.
Absolutely.
So just briefly, the first chart, obviously we had a weaker than expected payroll print in May, and you can see I've got my usual display of the cyclical sectors and the non-cyclical sectors. The non-cyclical sectors, government, education and health, as usual, printing, north of 100,000 jobs in the month. The cyclical sectors, manufacturing, leisure and hospitality, arts and entertainment, everything else, a very weak print. And it's not the first time we've had this. We had some weak prints in these cyclical sectors in October and November. The Fed pivoted in November, and all of a sudden the market went crazy expecting rate cuts. So we shouldn't get too carried away that this has been a super weak print.
Okay.
The other point I want to make just briefly is that actually if you look at real disposable income, so this is after-tax disposable income, so nominal income after paying the taxes and adjusting for inflation. In May, we had the biggest monthly increase of personal disposable income since January of 23, which I don't have on this chart because at that time it was very strong. But what we're seeing is private sector wages and salaries growing at a very strong pace. The number of employed people is still going up each month. And we've had weak inflation prints, which means that real disposable income is growing at a healthy pace.
Yeah.
So there's absolutely no reason why the consumer should slow down their spending. And in fact...
So it's Goldilocks at the moment.
Well, it does look that way. And in fact, the other thing is if you look at household wealth, and I've shown this chart before, this only goes, the green line is household wealth. And you can see it at the end of the first quarter, it got to $161 trillion. Two important things about this. First of all, it's increased by around between a third and 40% in the past 4 years. And the second thing to note is that household wealth is comprised 2/3 of equities held directly and indirectly through pensions, and the other third is housing wealth. And if you look at the path of the S&P up until today, certainly it's been on the up and up since the end of the first quarter. So we can be fairly sure that household wealth during the Q2 will also show another significant increase. So as far as I'm concerned, just putting it in a nutshell, I don't see the economy about to crater.
Very quickly, today, bonds up, equities down. Wow. I think that's I can't remember the last time that happened.
That is kind of strange.
Tell us quickly, one-liner, what do you think on that?
I think, as I see it, perhaps these recent signs of a slowing economy and slowing inflation just suggest to equity investors that maybe things aren't going to be smooth sailing.
Okay, fair enough. Very quickly, very briefly, your year-to-date, where are you standing at the moment, Jonny?
Well, it's just shy of 20% now.
Okay, very good.
I'm taking a very cautious approach because, as you just rightly said, things are not obvious.
Yeah.
It's kind of strange what we saw today. Treasury yields much lower, but equities not benefiting from that.
Yes, absolutely.
Yeah, so things are changing, and there aren't the obvious trades. There's only one or two obvious trades per year, and when you find them, you've got to really, really exploit them.
Okay, just to sign off, if you want to read what Jonny's talking about, do you want to subscribe to him? It's www.super-macro.com. Hit the subscribe button. It's virtually free for 30 days, and then after that, it's 50 quid a month.
Okay, well, I think I've spent enough time talking about the Taylor rule. It's time we welcomed our special guest on the show, Andy Constan.
Very special.
And for those that don't know Andy, he's the man behind Damp Spring. He's been an advisor to Bridgewater Associates. He was an advisor to Brabham Howard during some of the time that I was there. He was my boss at Salomon Brothers in the early 90s. He then went on to become global head of equity derivatives at Citigroup. He's run his own hedge funds, and now he writes a bi-weekly report for Damp Spring Advisors. And he's also frequently appears on mainstream media, on CNBC, on Fox News, and is often quoted in the Journal. So, Andy, thank you so much for joining us on the show. Welcome.
First of all, Jonny and I would like to thank you for the leg up you gave us early on when we first started on Twitter. We would never have been here in such a quick time had it not been for you. Thank you.
Sure.
And second one, I
really
want to
appreciate it. Thanks, Andy.
Now here comes a pat in the back. Last October, early November, congratulate you on your call following the QOA announcement. You said buy everything that wasn't nailed down. Tell me, could you just briefly take us through that, what your thinking was at the time, and how that, as I'm guessing, has changed to today?
Sure. So I think at the time it was very what had happened is that at the end of July, the Treasury announced that they were going to significantly increase the amount of duration that they were requiring the private sector to purchase, almost doubling from 175 billion to 338 billion of net coupon issuance in Q4. And the markets, for a variety of reasons, began to sell off both bonds and stocks as that supply was front run. And the expectation coming into the Halloween QRA was that they would again increase to something greater than 338 billion. And so what I was on the lookout for, I was positioned short, both bonds and stocks. Those I had rolled down, taken profit the whole way down, and came into the number short. And the number was a surprise in that it was only a $10 billion net coupon issuance increase. In fact, really what that is just one extra auction was on the calendar for that particular quarter, which is Q1. And, that was way below my expectations. So my natural desire was to go long assets. And so I did. And we rallied a lot. And that was then exacerbated so that was the Treasury's actions. And then the Fed met that same day and was fairly dovish. And then following that, Governor Waller described his view on how interest rates, the cutting cycle would begin. Remember, we were seeing some pretty weak data after a very strong summer of data. We were seeing pretty weak data. And I think that was because financial conditions had tightened so rapidly since July. And so the data came in weak, and the Fed said that in order to maintain the degree of restriction that they wanted to, if inflation was coming down, it made sense to reduce the Fed funds rate, because that would mean the real Fed funds rate would remain at the same level.
Yep.
And, they started using that rhetoric fairly aggressively, and even repeated it in the Fed meeting in December. And by soon after that, like days after, maybe the same day, the cuts for 2024 were priced by the market at 725 basis point cuts.
Oh, yeah,
and
the
as
market went
they
crazy.
haven't cut yet.
Yeah.
What's that?
The market just went crazy. The Fed said we expect to cut 3 times in 2024. The market just took the ball and ran with it. And absolutely, by January, 7 cuts were being priced.
Right, and that created a significant easing in financial conditions. Bonds rallied, gosh, from the lows. I think they rallied. Tens rallied. The Halloween high was something like 505, and they rallied down to 390 by December 27th.
Huge move.
That's just a massive easing in financial conditions, and equities took off along with it. On also the idea that we were going to that this slowdown that we saw in Q4 was going to bounce along with financial conditions, and the AI hype continued, and so equity prices rallied a lot and have continued to rally until today, on the back of stronger growth. Bonds, they've been choppy, testing 4.75, I think, on tens at peak, and now down to, I don't know, 415, 418 today. But equities have been a one-way train with a brief pause in April.
Yep. Well, let's just get your take briefly. Elvis and I have been discussing recent economic data, some softening, and then we saw today's CPI print, which was super soft. And the reaction from, obviously, we got the expected reaction from the rates market, but what's your take on the equity market reaction today?
We're just processing it now, and I wouldn't want to make any major pronouncements about equities on one day's move. It seems like there's a fair amount of rotation going on. The only sectors, well, the only stocks really that are down are the Mag 7 and those that surround the Mag 7. And all the other sectors from biotech, banking's a little soft, I guess. Biotech to industrials are doing fairly well. And Russell's tiny. It's about the size of one of these Mag 7 in total market cap. But, it's rallying, which, to me is more of a positioning thing than it is a macroeconomic thing, in that, Russell's been the only thing that's been going down, and all the other Dow hasn't done much, but all the other major indexes are going up, and people were probably short one and long the other. The rates market to me today is, well, let's step back. We've had a week, basically, I'd call it 6 weeks of pretty weak data. From jobs to JOLTS to NFP to CPI, PCE, PPI, almost all of the survey data has been pretty weak for 6 weeks or so. And, that's caused bonds to rally somewhat in what I would call still a range, and cuts to be now priced in at, September looks like it's a no-brainer as a cut, basically on an economic slowdown narrative, which, I'm genuinely expecting a meaningful economic slowdown at some point. And I've been, tossing around trying to decide whether that economic slowdown was going to play out. At this stage, the boat seems to be all tilted, at least in the rates market, all tilted toward a slowdown and a mission accomplished inflationary situation, that it makes me think that what I would call peak disinflation slowdown narrative has probably been reached in the near term. And so, I don't see any value at this stage. I've seen a lot of value in twos for a while now, and I don't have any twos anymore. I don't see much value in the front end of the curve given what it's pricing.
Well, we've been here before, haven't we? Like you said, shortly after that call of yours in October, we then had, we'd had a bunch of soft data. We had a couple of very soft payroll prints, and that was when the Fed got had that pivot and got super dovish, and the market went pretty crazy, pricing in cuts. And financial, as you rightly said, financial conditions eased a great deal. And then, economic growth picked up again. Do you think there's a chance that that's what happens this time? And also, as you rightly said, and I agree with you 100%, I think we've seen peak disinflation. So now progress from here is going to be difficult. What is your, you touched on it briefly there, but what is your outlook for the Treasury market?
Right. So as I said, I've been bullish twos and bearish the long end, looking for a steepening. That steepening has happened, and I think at least on the twos side, it's now fully priced into what I would expect 2%, the path of interest rates to be in either a soft landing, even a mild slowdown, and certainly would look foolish if, in fact, we do get that bounce. My highest level view on the economy is, at this stage, remains that that financial conditions matter more than the Fed thinks, or apparently thinks. Maybe they think something differently. They actually have their own FCI index, which I think is worth pulling up. They have a 1-year look back and a 3-year look back, and both of those are reading accommodative today. But at least half of the Fed is ignoring financial conditions and focusing on that real Fed funds rate that we heard from Waller, which I think Williams and Powell in particular, in terms of the people of influence, really believe, and they don't believe in the financial conditions narrative. About 9 of the governors are have pretty high long run interest projections for Fed funds, meaning the long run neutral rate, and that's a big dichotomy amongst the Fed members. So some of them are accepting financial conditions as mattering. I weight them more heavily than others. And so with financial conditions as easy as they are, now they could tighten, we could sell off, we could go down limit on stocks and financial conditions could suddenly tighten. But without that, financial conditions are easy enough that I think we'll have a fairly decent economy in the back half of the year. And that's bad for bonds.
Well, I'm glad you said that, because that corroborates what we've been discussing prior to you coming on the show. So we're very much in agreement with that. So as far as you're concerned, the neutral rate is now higher than it was previously. It's a different economy. And if we look at financial conditions, that is really reflected in household wealth. And to me, when I look at the increases in household wealth over the 4 years since the pandemic, they've been absolutely gigantic. The household wealth has gone up about a third or 40% or so since then. So consumers are in great shape. They don't really need to increase their savings rate. It is low, but for a good reason. Is that how you see things?
Yeah, including wages, which remain, strong because the labor market remains tight. And I think a lot of the people that think the Fed needs to cut are concerned about the jobs market, as is Powell. And so, if we do get a dip in employment or an increase in the UR, that may cause them to validate the pricing and cut in September and maybe in December as well. But with FCI where it is, it seems like that will
pour gasoline on the fire, right?
Yeah, it just doesn't make sense. Yeah. Now, the question when you deal with FCI, a lot of people say, well, the stock market level is not something the Fed cares about, which is by and large true. But what they do care about is the ability for, who in the economy needs to borrow, who in the economy needs to raise capital, and who in the economy needs to be incented to hold either cash or assets relative, or mostly cash, and not consume. And At this stage, with financial conditions, so to me, when I think about the Fed funds lever, I don't think that the economy operates at all based on the level of the short-term rate. Back in the day when, there was, when bankers would ride the yield curve and borrow at low rates and lend at high rates and take the duration risk and live their lives in a positive yield curve environment, the short-term rate mattered. It meant that they needed to increase their long-term interest rate to them to keep their spread. But the economy doesn't operate that way. Banks don't take as much duration risk, particularly after SVB. And their clients don't want to borrow because they've already borrowed at extremely low rates. So in this economy, that Fed funds lever really isn't connected to much in terms of what it does to the economy. The only thing it does do is make holding long-term bonds unattractive from a carry standpoint. And so you've seen most of the levered investor, banks in particular, really abandon buying long-term treasuries because the carry's bad and they can't own the duration risk. And so they just simply don't buy. And that is the nature of those who are affected by the short-term rate are just very few at this stage. And so what matters to me is where equity cost of capital is for those private equity companies that need to come public or need equity financing from private equity or venture capital, or public companies who don't need the money, who need to raise equity. And no one cares. No one is being hurt. No one is choosing to reduce their projects, hire fewer people, do anything with cost of equities that are so attractive and with their balance sheets the way they are. And their cost of debt is also very low. Even mortgage rates are high, but they aren't restrictive. So to me, I look at all of those conditions and say, the thing that the Treasury is pulling on just isn't having the effect it needs to have. And so as long as that keeps going on, bonds are going to be a sale. They may not sell off because there's no bond vigilante that can actually cause them to sell off, but they're not good value, and equities are better value, but they're already priced for very high earnings.
Very much agree.
Yeah,
with you.
that's part of I think a tweet you sent out recently. I'll get this right. You consider bonds are priced for nominal GDP of between 4 and 5%, and equities are priced between 5 and 6% plus for nominal GDP. There's something wrong there.
Less than 4 and more than 6.
Okay, all right. So there's
I don't remember exactly what I said, but that's mostly it. And really if what happens is we end up at 5, both bonds and stocks sell off.
Yeah.
And that's how I'm positioned at this stage.
One final thing that I want to discuss with you that we haven't covered yet is the fiscal deficit and the extent to which that might influence pricing going forward, and also what should we look for in the composition of the issuance of the Treasury issuance, in the QRA, what the proportion of bills to coupons and so on. What kind of things should we be looking for as warning signals?
Right. So let's start with the deficit. The primary deficit is in gridlock, and the primary deficit means the spending that the government authorizes. It can't do anything about the spending that is formulaic, things like changes in the interest rate that they have to pay, or some of the spending that's linked to inflation, et cetera. They also can't do much with the revenues. Tax rates aren't changing, so it all depends on, what the private sector earns and pays taxes on. But that's mostly stable. What isn't stable is the interest rate that the government is paying on its debt, and that's rising very slowly. There's a cohort out on Twitter, at least, and some of the sell-side firms that, will create some things that say that the cost of interest for the government is going to rise by $700 billion in the next year. I think B of A had something like that due to refinancing of the existing debt. And, that's mostly almost entirely wrong. I've done CUSIP level analysis of every bond that the government has, where it would refinance when it matures. Remember, you don't have to pay more interest until it matures. And the levels that existing debt is already, which is mostly bills, is already at these very high interest rates, 5% interest rates. And so the increase in the deficit depends on spending and taxing. And that's going to be either in gridlock or a clean sweep by the red, or which seems more likely given the situation in politics now, or a clean sweep by the blue. And in those two cases, you're going to see deficit rising, primary deficit rising. So I look at the deficit as having upside with potentially flat and modest increases due to the interest rate factor. And so I don't think it has any impact on the Fed at all in terms of what policy they choose, mostly because the worst possible thing for the taxpayer is for the Fed to fail to kill inflation. Because at that point, not only does the short-term refinancing rate go up, but the long-term refinancing rate goes up. So whenever they issue a new 30-year bond, they're paying 5-6% or more if inflation isn't killed. So I think that's their objective, and I think they will do what it takes to do that. So now we get to why are bonds continually heavily inverted? We've had a bit of a steepening lately, but still inverted. And why are term premiums on bonds so low? And that is because of the demand-supply dynamic between buyers of bonds and sellers of bonds, with one of the biggest sellers of bonds being the U.S. Treasury. Now, when they sell, they actually spend, and when they spend, that money comes back into savings and could buy those bonds. So it is a bit circular. But what we have in the current portfolio of issuance that the Treasury has is about 25% of the total issuance is floating rate, either bills or their floating rate notes that they issue, 2-year floating rate notes. And that is a level that is well above their long-term target, which is between 15 and 20%. And typical only when there is a recession. And so the Treasury is in the position of having bonds, long-term bonds, having a lower coupon by a fair amount than bills, and very low term premium, which means it's a good deal to be an issuer. And so just like they started increasing coupon issuance in July of last year, they increased it again in February, and they maintained $500 billion of net issuance in the May QRA. And so they're on the path to issuing more bonds. The problem is the deficit's still pretty big, and so they're also issuing more bills. So just from a framework standpoint, bills are fungible with cash, are fungible with deposits, and are fungible with the money market funds. And as we know, the Fed continues to offer money market funds about $400 billion worth of funding, worth of investment options in the RRP. And so there's still quite a bit of capacity for the private sector to shift from the RRP to bills. So bills supply and demand doesn't interest me. There could be more bills or less bills. This quarter, for instance, they're issuing negative bills because not this quarter. It's Q2, they issued negative bills because they get a lot of tax receipts. So I expect them to continue to issue a lot of bills, but what is the important thing to look at in the QRA on the 29th will be whether they increase their coupons. And they've told us they won't. In the TBAC minutes, TBAC presentation, they indicate that rising deficits will cause them to need to increase coupons, but they do not plan on doing that in the next QRA for Q4. Now, since that came out, the deficit projection by the SIBO has gone up by $400 billion. So it's possible that they surprise the market with an extra, I don't know, call it $100 billion of coupons. It's not my base case. My guess is, now, at the same time, there's a cohort that are very political that believe that for whatever reason, Yellen will pump the economy because it will somehow mean that it increases the odds of the president being reelected. Now, I think if she had that lever that could magically cause him to be more elected, she would pull it. But she doesn't have many levers like that. She can't spend because Congress is in gridlock. And so she has these two levers. One is to decrease the amount of coupons, easing financial conditions more. And the other is to spend her bank account, which is called the Treasury General account, which is currently targeted for the end of September to be $850 billion. There are some out there who think she will spend that, even though there are statutory reasons that she won't, and reduce coupon issuance by funding the government with her checking account. And so I suspect there'll be a cohort that says that the QRA is going to be a pump, and there's a cohort that's like me that says it's not going to be a pump, but it also might not be much because they've told us it's not going to be much. And then there's the potential for a surprise because I don't know if you noticed the presumptive Secretary of Treasury under Trump just wrote a piece that Bloomberg picked up on this issuance process, calling out Yellen for doing that. And Josh Frost, the guy that actually runs that part of the government, is responding in a speech tonight. There is a fair amount of political pressure. And in the Senate testimony to Yellen and most recently with Powell, Senator Kennedy, and then I don't remember the name of this senator 2 days ago, another senator commented that, Republican, commented that Treasury was manipulating the economy by its choice of issuance. And so there's political pressure. At least people are watching a pretty narrow topic, but at least they're watching. And so I'm fairly confident we're getting at least the same amount of coupon issuance, which is a shitload. $550 billion per quarter is a lot of bonds to absorb. Now, that said, the market's absorbed them so far. Now, I wonder if that's simply just the economic slowdown and disinflation causing the demand for bonds in the short term.
Isn't it healthier for the government to term out the debt from just looking at the overall situation and saying, okay, issue more coupons rather than bills in the long term?
I think the term premium is a real compelling thing. But they also claim, and I think that it's true, they can't operate as a market timer. And what they have to do is look at where they are and where they're heading. And where they're heading is 80% or more coupons, and they currently have 75% or less coupons outstanding. And so they're heading in a direction of 5% more coupons. At the same time, bills are still needed because the deficit is so large. Right. So it's a big ask to fund. You have to really increase the auction size to both cover the deficit and make progress on the bills coupon ratio. And so they're stuck a little bit. And so, my projections are 2 years from now, and this is with relatively basic funding, no big change in the deficit, no big change in the macroeconomy that creates a bigger deficit. My projection is they're going to be issuing $700 billion a quarter come 2 years from now. So the amount of coupons is going in one direction. The question is, and I make a meme about this, will the camel's back ultimately break by each new auction dropping another straw on its back?
Yeah.
And I think the way you can see whether it breaks is whether term premiums expand and the curve steepens. And that's my 6 month to a year view, that we're going to get that term premium expansion, and that's bad for all assets.
Yeah, that's very interesting, because some of the nuances that you pick up from the TBAC committee and the political aspects of the Treasury issuance, we probably don't pick up that kind of stuff here in Europe. But I've certainly learned a lot. Thank you very much for joining us on the show,
Before we go,
Andy.
I've got a very important question for Andy. This is more
Sure.
important than all the macro, much more important. Favorite rock band. Now, hold on a sec. I've got your top 5 here. There's one of them. I didn't have a clue what it was. Who is CCR?
That's an old one. Creedence Clearwater Revival.
The young guy had to look it up on the internet. I had no idea. Is it? Excuse me, I can't even pronounce.
Favorite child?
Creedence, favorite child is favorite son is one
Favorite
of their
son,
songs.
I beg your pardon.
Trump used that, and the author was very disappointed about that. They were actually one of the most prolific hitmaker rock bands of the 60s. Like, in the 3 or 4 years that they operated, they put out some of the most popular music ever written, rivaling the Beatles, frankly. And I think they're great. Is that my favorite band? I don't know. It depends on
the Beatles one, and we both agreed with your number 2, Zeppelin. That was my first album, Zeppelin 1, when I was early
Did
teens.
I have the Beatles 1?
You had Beatles 1, Zeppelin 2, CCR, you now explain who they are, 3, Bob Dylan 4, and, well, he liked your 5th, Talking Heads.
Great live, aren't they? Brilliant.
I'm going to say that today, I feel like Pink Floyd number 1, Zeppelin number 2, Grateful Dead number 3, CCR and Talking Heads 4 and 5.
I'll put number 6 in there, something for you to listen to, The Architects.
No, never heard of them.
Oh, you want to have a listen to The Architects. It's a bit heavy, and make sure you're in the right mood, but have a listen to them. Andy, I've got to thank you enormously for joining us on the show today. Thank you very much indeed. Just in case there's anybody in the world who doesn't know who you are, there can't be many, do you want to tell people where they can read your work and subscribe,
Sure.
etc.?
Dampspring.com is my website for those who want to subscribe and have a close relationship, hands-on, one-on-one relationship, which is what my service offers. Two Graybeards, where I work with my partner, Nick Giovannic, who's also on Twitter, for those who want a very short, once-a-week video about what's going on to help them have better conversations with their financial advisor. And then on Twitter at Damp Spring.
Thank you very much, Andy. Great to see you again. Really appreciate it.
Pleasure.
Thanks.
See you
Thank
guys.
you.